Now, East Africa's biggest stock market by valuation has been setting a string of record lows in the month of May. It hit 1,669.94 points in trading on the 24th of May. In fact, since the start of the year, the NSE 20 has fallen by over 12%. The market cap has fallen to just around $15.6 billion. Compare that to the market cap of around $22.3 billion at the start of the year. So essentially, in this 144-day run, that roughly translates to the market cap falling by an average of $48 million every single day. Now, a big slice of that most recent decline can be attributed to Safaricom. Its shares are down by roughly 30% so far in the year. Now, since Safaricom alone accounts for more than half of the market cap at this pause, it tends to have an outsized effect on the direction that the NSE 20 does take. But it's not the only counter in the red. Virtually all Tier 1 banks have seen double-digit declines in their share prices. The macroeconomic outlook for Kenya as we approach the second half of 2022, yeah, well, it doesn't look particularly good, does it? At just under 6.5% in April, inflation is the highest it's been since September last year, and it's still rising. Food prices account for roughly a third of household expenditure, and it becomes bigger the lower down the income ladder you go. Fuel prices have gone up by over 12% year-on-year in April. And amidst this environment, remember that households' earning power had fallen for 2 consecutive years in 2020 and 2021 to just under $6,200. Households clearly have very limited room to absorb these sort of price hikes. So with this sort of conditions in mind, we thought to carry out a little thought experiment. If you had $1,000 to invest in East Africa in the next 12 months, what are your options? I explore that with Kevin Maina from Genghis Capital.
So maybe I can take you back slightly. If you look at, say, around 2015 to around 2017, you'd realize that the average foreign participation on the NSE normally would average around 75 to at times as high as 86, 87%. If you look at April this year, that number goes down to around 53%. And that just tells you the capital flight that we're seeing on the Nairobi Securities Exchange. And yes, it's in part to the macroeconomic environment, of course, the foreigners are seeing. And then, of course, in other parts, thanks to improving macro environment in the developed world, especially when on rising interest rates. So yes, we are going to foresee this. And of course, remember, we're just 3 months shy to an election. Normally, during these cyclical 5-year cycles of electioneering periods, we tend to see some capital flight off our market. So I don't expect this to change, at least in the next quarter.
All right, then. So let's drill down on that, notional budget of $1,000 that we have with respect to Kenyan equities. In the last 5, maybe 7 years, the running joke in the market has been that, you buy Safaricom, buy a couple of Tier 1 banks, maybe EABL and go home. Does that argument still hold at the moment? If equities was the only place we're putting in this hypothetical budget, would that strategy make sense?
It's sad to agree, but it's very true. I mean, if you look, we are having decade-long IPO drought in the country. So with the exception of 2 or 3, we've seen the rates, which of course has gone down, has been beaten down. Of course, we've seen Home Africa, Homeboys, I beg your pardon, which again has been beaten down. So if for an investor looking at quality companies, then again, you're just left with the Tier 1 banks, Safaricom, EABL, and probably BAT. So as sad as that sounds, yes, it is true. There's only a handful of stocks that an investor can buy and have a good night's sleep. As of considering we have 65 listed counters, I would take that to be maybe around 15 to 18 stocks.
So is a sensible play here then with this hypothetical $1,000 budget? Is a sensible play here then to simply just take the money, dump it into high-yielding Kenya shilling bonds?
Well, I'll reiterate, you have to really, depending on the kind of investor, of course, in your risk preferences, on the age of the investor. For young investors, generally, they tend to play around a bit or more on the equities. But then I would break it off into a seasonable portfolio. If you look at local institutional investors, they almost usually have a 60-40 split or 60-30-10 to bonds, equities, and liquid cash. So I would, of course, the yields are now attractive, but then again, based on if you're following recent events with expected rate hikes, we might see some trade-offs, and we might see actually some unwanted or pushed buys into the equity space, depending on the fiscal space going forward. So equities could stand to gain on a rate hike. I know that sounds weird, but yes, we could stand to gain.
All right. So in the responses, again, to the survey we ran on Twitter and on LinkedIn, 2 other asset classes, especially with respect to Kenya, came up: land and cryptocurrency. Now, I know we're working with a relatively limited budget here, but is there room in this budget for any of those two asset classes? And if so, why or why not?
So two things you've mentioned, land and cryptocurrencies. Land, especially on periods where we tend to see hyperinflation and the currency just being beaten down, then land investments usually tend to make sense. Of course, there's our figurative 100,000 is too little to buy land, but assuming it was a sizable enough that could incorporate land investments. The biggest problem with land investments, especially in our country, is you tend to see some of these lands, parcels or pieces of land that are sold to the populace and most investors run to. You'd find the lands that are remotely located in nowhere. So you have to be very cautious when, of course, investing in land. There's a nice product that has been brought to the NSE. It hasn't really taken off as expected, and that's the I rates or the D rates. So that could be another asset class if someone wants a space or exposure onto real estate.
Given what usually happens, at least in this little corner of East Africa, right? This whole approach of buy the land, it's something that's tangible, I have it, and essentially I'm banking, I'm betting the farm, proverbially speaking here, on just capital appreciation and nothing else. It's very rarely a case of I'm buying the land because I'm going to put up houses, or I'm buying the land because I'm going to farm on it. There's rarely ever any economic activity that's essentially being put to use on that land. In that sense, isn't it just, a dead asset?
That's true, true and true. I totally agree with you. That's the problem we have in the country. When you turn 18 and guys from between 18 and 25 on their first salaries or their first real incomes, you tend to see a couple of mortgage spikes and just people buying land just for the share fun of it, for let's say. So it's almost some sort of gambling. It's not buying to put anything tangible. It's not a business. It's not putting up real estate onto it or farming. It's nothing sustainable, if I may put it that way. And that's when you tend to see a couple of investors really burning their fingers just buying assets that are dead assets for that matter. I think the investors really need a careful approach onto that space, basically.
All right. So, well, now let's wrap it up then. $1,000 hypothetically, do we replicate what fund managers do here? 60-30-10 into bonds, equities, and a bit of loose cash. How would you allocate it?
I'll my 100K, I'll take 40K and put it, of course, into fixed income. Thanks, of course, because of all these exogenous factors we are seeing, that's almost a store of value. I take 20 and put it into commodities and metals, say something like gold. And for that, again, for the store of value, I'd take another 30 and put it into equities. I mean, I'm a young investor, so I should have, if I buy quality equity shares, especially the tier 1 banks and Safaricom, as you mentioned, and that brings me to around 80. For the 10, I'd have it in cash, and the 10, I'd have it in crypto.